In this video, I look at an intergroup transaction where inventory was sold from the one company in the group to the other, and in the second company treated as a plant item. I'm using Tude question 1713 to look at this concept. So we see in 1713 that Jade sold a piece of plant to Laura. Jade manufactures the plant, so for them it's inventory. Laura treats it as actual plant, so for them it's a non-current asset. Jade recorded sales of proceeds on the sales of $25,000, and it cost them originally $17.5 to manufacture the piece of plant. So they recorded a profit of $7,500, and this was on the 1st of July 2011. We're busy with the consolidation adjusting entries for 2014. So from the point of view of the consolidated financial statements, we would like to see the following. There should first of all have been no sale of inventory. So the effect of that sales transaction, even though it was 4 or 3.5 years ago, have to be eliminated. Secondly, there was no acquisition of plant. So the whole transaction relating the purchasing of the plant needs to be reversed, and the effect of that, because the plant would have been recorded at a different value than the original cost of manufacturing that plant. So by reversing this transaction, we also have to make an adjustment on the depreciation expense. So from a group perspective, what actually happened? We had a reclassification of inventory to plant. And this is our aim, that in the end, it just appears as though a piece of inventory was reclassified as plant. And our adjusting entries should get us from the combined results of the individual accounting records to a consolidated set of results where inventory is reclassified as plant. So let's have a look at what the necessary adjustments are. If we look at the inventory line item, in the current financial year, we would have no inventory in the parent company and no inventory in the subsidiaries' accounts. From the group perspective, we should have no inventory because the inventory is reclassified as plant, so therefore there's no adjustment on the inventory line item required. On the plant line item, Jade would have no plant recorded because for them it was never a plant item, and Laura would have plant of $25,000, which is what they purchased the plant for. However, from a group perspective, the cost of the plant was not the $25,000, but the original cost of manufacturing it. So for the group, we want that plant to be stated at a cost of $17,500. So every year we have to make an adjustment of reducing our plant balance by $7,500, which is equal to the unrealized profit that was recorded initially when the sales transaction occurred in the accounting records of Jade, the subsidiary. So that is the first bit of our adjustment to the value of our plant and machinery, is to reduce our plant and machinery by crediting it with the unrealized profit that sits in that asset, in the value of that asset, $7,500. The unrealized profit in the accounting records that was recorded in the accounting records of Jade would be reversed against the opening retained earnings because it's still unrealized from a group perspective, and because no external party was involved. So that's the after-tax effect of that unrealized profit. It's adjusted against the opening retained earnings. And because of this adjustment to the carrying amount of an asset, we have to consider the deferred tax consequences. So we raise a deferred tax asset because we reduce the balance or the value of an asset. So we expect future tax benefits when the asset actually realizes. Maybe just a further explanation on the adjustment against the opening retained earnings. In Jade's accounting records, they recorded the gain on selling or the profit on selling the inventory in their profit and loss on when the sales transaction occurred, and that would have carried forward every year in their retained earnings opening balance. However, when we reverse that transaction on a group level, it means that we want to reverse that profit that was recorded 3.5 years ago. So we don't want that effect in our opening retained earnings balance. So it's, in order to get it to a value of 0, we have to pass a debit entry against our opening retained earnings of 5250. Now, as with any depreciable asset that is the result of an intragroup transaction, there will always be 3 adjustments. First of all, to get the value of that non-current asset to what it should be on a group, from a group perspective, then to make the resultant depreciation adjustment, because your depreciation expense will differ on a group level than what is recorded in the individual accounting records, because the asset has got a different value. And then when we make our depreciation adjustment, it goes hand in hand with that is to then record the tax effect of that adjustment. Let's look at the depreciation adjustment. In the accounting records of the parent company, Lara, we would have for the current year a depreciation expense of 2,500, which is 25,000 cost of the plant depreciated at 10% per annum. At the beginning of the year, our opening retained earnings, or the opening balance on retained earnings, would have included the effect of depreciation at 10% per annum based on a cost of $25,000 for 2.5 years, so a total amount of $6,250. That would be incorporated in that opening retained earnings balance. However, from a group perspective, our depreciation should not be based on the 25, but on the 17.5. So if we do the 17.5 over 10 years, it gives us, for the current year, a depreciation expense of 1,750, and for the first 2.5 years after tax, 4,375. So our consolidation adjustment entry should then change our depreciation expense from an expense based on the 25 to based on a cost of 17.5. So we have to reduce our opening retained earnings balance with 1,875. Sorry, this is not, it's my mistake, it's not based after tax because we do the tax separately. So that's just the 1,750 for 2.5 years. And for the current year, our depreciation should not be 2,500, which flows through from the parent accounting records, but should in effect be 1,750. So we have to reduce our depreciation expense in the current year with 750. Okay, so that's our second entry. And we make those adjustments against our asset contra account, accumulated depreciation. Because we adjust the carrying amount of the asset with this component of the transaction, we have to make an adjustment against the deferred tax asset. And for these two, we have to also incorporate the tax effect of those transactions.